All right, so every week I like to start off the show with a summary of kind of what I saw happening in the stock market. As I mentioned, I do a video, every day about the market, but I try to do one for the whole week. For those people that don't want to watch it every day, they can just watch the Friday one and see what, happened this week as far as that goes. So let me get the screen up. Okay, so we've been showing this chart for a while. This goes back to 2019. This is a weekly data chart, so we can get a lot of data on one screen here. You can see the big 2020 drop, that happened because of the pandemic, and then everything was closed down. They were going around, trying to stimulate everything and sending out stimulus checks and pumping money into some of these businesses. The airline travel dropped 96%, for a while. And they overdid it. Let's face it. I mean, the economy was actually doing better than they thought. It was a bit of a panic situation, which we can completely understand. And we ended up with one of the sharpest upruns I've really seen. And so all of a sudden, we had high inflation, peaked out, right? At the very end of 2021. Beginning of 2022, they started raising rates quite dramatically, basically from 0 to about 5.25, in that range. And the market dropped 28%. Still higher than where we were before the pandemic started. So overall, the money that came in still created some value altogether. But it was a really rough ride. Peaked, bottomed out October 13th, 2022. Nobody thought that was the bottom, including us, even at that time. Although we weren't nearly as dire in our predictions, people still felt the market was going to fall dramatically from there. Matter of fact, Wall Street was dead wrong. We were following the trends at least and kind of hung in there and did quite well in that regards. But because I do believe that, you got to be careful about trying to predict where things are going to go. Mm-hmm. And that's the most common thing that you see on shows, articles, whatever it might be, people predicting where things are going to go because that's what people want to know. I get asked all the time, what do I think about this? What do I predict? We believe much more so in a reactive environment where, we have a list of 181 ETFs. We just watch those and see which ones are moving up, and we're grabbing those as they come up, as that wave happens. And then as they start to fall backwards within that group, we have a cutoff line. We'll sell that. We'll buy something else. And what's momentum trading? Basically, the concept is once something's in motion, it'll stay in motion for a period of time. Mm-hmm. And then you kind of ride that. And that's, most of what we put is just kind of in the market as a whole. And then we take this section and we do these targets and we try to ride these targets and try to, outperform the market with that. And, we've had some success with that. But if you look at what's happened now, I mean, it's crazy. October 27th of last year was kind of the bottom of that 10% downturn that we're looking at there. And we've had, other than April of this year, where it's down 5%, you can see that little jag down, we've had a nearly straight up market. It's really incredible. And so if you can't have fun right now, you're not going to have fun as an investor. If you're worried about where things are going to go, that's probably okay. That's what keeps us honest. But still try to enjoy, somewhat so what's going on, because this market is being driven by, I think, sound concepts. It's not just some kind of mania. I mean, if you look at what's going on, inflation has subsided. Good, still higher than they want, but they're talking about lowering rates much more so than raising rates, right? Expectation is 1 or 2 cuts. The Fed is kind of at 1 cut. I mean, this is not what we were talking about in 2022. It was how many raises we were going to have, and that's why the market was really struggling in that environment. You combine that with company earnings, which have been pretty good, especially in the bigger companies.
Yeah, the mega caps have been running heavily.
Oh, they've been doing really, really well. Matter of fact, the thing about these companies, they've been doing quite well as a whole across all of this time frame in terms of, even during the pandemic, your Apples and Microsofts and Googles and Amazons, they didn't always do as spectacular as you might want, but they've done really, really well. And some of them have done spectacular. And of course, then you throw in the artificial intelligence component here, which, seems like a hype and what have you. But when you look at earnings and you look at what's going on, I mean, Adobe had a 15% hop on their, earnings report because they were able to show kind of where they were making money off of artificial intelligence and where, more importantly, they were going to be making money off of artificial intelligence. Mm-hmm. Of course, NVIDIA was up 486% on their earnings growth in a 12-month period. That's a real number. This is now the largest company in the world on a capitalization basis. Did they fall back yesterday?
Yeah, they dropped to, I think they're second now.
Second now, okay.
Yeah, after the last couple of days.
But you don't see that kind of earnings growth in
Yeah,
that
they went from a
size
$1
company.
trillion company to a $3 trillion
Yeah.
company in less than a
Yeah,
year.
I mean, usually when you see those type of triple digit, in this case, mid triple digit earnings growth over a 12-month period, it's a small company, something that, they've just really got going as far as that goes. So great run. Momentum is super strong. I can stack up so many statistics as to why this is going to continue. It's not even silly. All kinds of different things that have happened. How much it gained in November, was 8.9%. When you have a month like that, you end up with a very much so an overperforming market for the next 12 months. I mean, over and over, even this year, when you have 10% or more in the first half of the year, you end up, with a very good year for the whole year on average. I mean, it's just stat after stat after stat that shows essentially what we believe in, which is that a body in motion continues in motion up to a certain point in time.
Yeah, and you're gonna have ups and downs. You're
Yes.
gonna have those Aprils where you're
Yep.
down 5%, or
Yep.
you're gonna have those short runs like last year where we had 3 months where we were down close to 10%.
That's exactly right.
And so you're gonna have the ups and downs, but overall the market's still going up.
Yeah, exactly. And so, I think one of the stats that's really kind of interesting to me, if you go back, to the 1920s, the average bull market, up market, in case you don't know what bull market is, 3 years, okay, give or take. And we started this in October of 2022. We're roughly a year and a half, a year and, I don't know, 2/3, however you want to look at into that. If you look at the bull markets since 1970, really since the Federal Reserve and the Congress and different things, they started figuring out kind of how to, manage the markets a bit, especially since 2008, man, they started all this money coming out and what have you. We're talking about a 5-year average bull market run in that time frame. And so obviously, just again, another stat that shows that there's some potential for long term. Now, there's always something out there, like a virus, right? We were on a pretty good run in 2019, dead stop by that virus, right?
Yeah.
So whatever it might be, there's always something out there. It's always something you have to be aware of. And it's why we watch our universe of ETFs and we say, okay, what's moving? And, usually you'll start to see some creep and you'll start to see some things kind of coming through as kind of, warning signals as far as that goes. And so when we look at kind of what's happening right now, so this is something, there we go. This is something we started last week. Now the dates are when we had our last change. Okay, so not today or whatever, but this is the last change for these. So the hourly, daily, weekly, and monthly charts on the S&P 500 are all showing that the primary direction is up. Okay, now the hourly one changes much more frequently, obviously, than the daily, and I wouldn't pay too much attention to it, other than we use it as an entry point for new money that comes in. So if it's green, we'll continue to buy as the new money comes in. And when it's red, the primary direction, at least on a short-term basis, is turned down. We'll wait until that turns back up again, just in case, right? Because the next big downturn will start with the hourly. But it's sort of it happens too often to really, trade on or do any of those types of things. The daily is much more important. Actually, a daily primary directional down change, downtrend, going from primary up to primary down is actually a pretty big deal. So when that turns red, we start to get real serious. And obviously we'll see a lot of change within our ETF universe. We'll see much more defensive things coming up by that point in time. So for example, if we go back to this chart, when you look at this downturn, the 10% downturn that happened last year, we stayed in because the daily was still green, right? The primary direction was still up. And I'm really glad we did. The market jumped 5% off the 27th of October really fast, in a week or less. And it was up 8.9% in November. And so that's why, now the primary direction comes from Charles Dow. This is from the 1800s, right? He's the founder of the Wall Street Journal. This is a really study of his writing. That's called Dow theory. He didn't make it per se. That was made later after he actually passed away, but it's from his writings. And so this has been around for a long time. It's just a way to look at highs and lows and the direction of the market. You can study, Dow theory. Pieces of it are dated, like, what's happening with transportations and things. We'll talk about that in a minute. But essentially what we're looking at here is a primary direction that's up. It wasn't violated in that downturn in 10%. We rode through that, and I'm glad we did because things are going quite well right now. So So we'll show that, when things are happening, so you kind of can tell what's going on. Also, you look at that and say, hey, it's strong, right? If you look at the first four boxes, this market's strong. Okay, good. Then we look at breadth. Now, breadth is not, okay, and I had some questions about this because we presented this last week. Breadth is not an early indicator warner. You go back to some of these smaller downturns and you'll see them all green, right before it turned down. That's not what we're looking for here. On some of the really big downturns, you'll see some more deterioration. So when we get to the peak in 2000 or the peak in 2008, you will probably start to see some breadth deterioration, some narrowing of the market as it's about to keel over. Obviously, that's not happening now. Everything's green. What I look at this more for is in those smaller downturns, when we are starting to have that 5 or 10% downturn, how many of these things are starting to turn red? Should I be more concerned? Even though we're still in the primary direction that's up, let's say, from end of July last year to the end of October last year, how many are starting to turn red? And how many things are we looking at there as far as that goes? And so there's only one red one here. It's transportation. Transportation was part of Dow theory. And the idea was that transportation led the economy. Because back in the 1800s, there was no digital economy. Everything was physical, right? It went through a train, and what have you. So if you watch those stocks, if they started to deteriorate because of, dropping volume, essentially, then that could be an early indicator. We still have a lot of physical goods that make up this economy. So it's still somewhat accurate. But right now, the money's being made in areas, they don't need a train to deal with artificial intelligence per se. And even the semiconductor chips don't take up much space in a cargo hold of an airplane, those type of things. And so still it's down a bit. We'll see what happens. Does that mean anything or not? But this will be kind of an interesting exercise to take a look at on a regular basis. But I will say right now, obviously the market is super strong. I presented this chart last week. I just wanted to present it again because we are heading into a seasonality right now that's quite important, okay, to understand. So even though the market's doing quite well, it could do better here. Maybe not for long, but for a little while. So if you look at the kind of the best months, so first of all, it says how many months on average are up. So 75% of July's,
A
positive going back to 2004, okay? So it's a good month. That's what's coming. Here we are, sitting on the 21st. We're looking at July. But the average rate of return is actually the second highest, right? November, interesting enough, is the highest. 2.5% average, again, on the S&P 500, 2.4% in July. But I want to take this one step further, what they're calling the wall of money that's coming in. And so it's all of these passive investments that come in and they get rebalanced at the end of the quarter and the end of the half of the year, which actually happened to coincide with June 30th. And so I got this chart from from Bloomberg, and it's hard to see this a little bit, but first half of July has the best rate of return of any 2-week period or any half-month period, however you want to look at that, right? The worst is the second half of September, which is kind of interesting as far as that goes. But if you look at kind of what's going on, look at that, the second half of December, the first half of April. A lot of people credit that first half of April with all these IRA contributions coming in and what have you. I don't know if that's true, but it has been a good time frame. The first half of January certainly was true this year.
Yeah, it's very common in January where people sell out in December and then they buy back sometime in January.
Yeah, exactly. And so that's coming at us, right? And so one of the highest average rates of return months of the year, combined with the highest 2-week period. Now, this is going back to 1928. So this is significant data looking back over a very long period of time, the first half of July. Now, the market tends to get softer after the 17th of July. Where's the second half of July up there?
Oh, it's right in the middle.
So it's a zero. Okay, so maybe we make all of our money in the first half and then we scoot through the rest of the time frame. I do think there'll be some interesting things happening in July because the Federal Reserve meets again, and sometimes the market gets a little rocky around that. We got the Fed minutes that come out from the last meeting. Usually, the market is okay unless they start like last time talking about some rate increases. Maybe they won't this time. We'll see what happens. But And we're going to head into maybe a softer period here in September. Both the first and second half of September are in that bottom piece. And if we go back to the monthly, September is a negative 0.06%, right?
Yeah.
Up 60% of the time, so it's up more often, but the overall return is slightly down, right? So I do think there's some seasonality here that's important to pay attention to as far as that goes. And really, right now, I think we're in for a continued run. Like Easton says, even in the best markets like we're having now, we still had a 10% downturn last year, even though the market was up over 25%. We've had at least, one 5% downturn here. Wouldn't be surprised to see another something happen. We're going to head into election. I got a lot of clients ask me about the election and, worried about that and what might happen and, those types of things. And September is right there with its negative seasonality. And people might say to themselves, hey, I'm just going to wait and see what happens. And I think that happens every election, actually, even one that's not as contentious as this one. And that's why you often see November. And you see, if you look closely, the first half of November is actually up on that list.
Yeah, that's one of the better ones.
Probably partly because of the every 4-year presidential election, and that it's known, we know who the president is, we know what the Congress makeup is, and that money that was delayed coming in kind of floods back in. Just my theory, but I've seen consistently throughout my career a very good run right after the election, no matter who's elected.
Yeah, there's going to be half the country just kind of happy,
Yeah.
So you're going to have that run up.
Yeah, and it's just delayed money coming in. And so, the one thing that could help September, that's where the market is really focused. Maybe it won't help because it might not happen, but it's really focused on a a Fed rate cut.
Yeah.
And so, if we have one, I think the market would respond positively to that. If we don't have one, it'll probably just exaggerate, the situation, the pre-presidential election. And again, I've mentioned my outlook on the election. Just in my experience throughout time, first of all, the market responds the most negatively to the unknown, the thing that we're not talking about. Okay, so Lehman Brothers going out of business, 100-plus-year-old company, folding up, and not knowing that there's $7 trillion worth of credit default swaps. These are insurance policies on top of mortgages that are all going to come due because mortgages are failing at a rapid rate because they were giving them out to anybody, right? None of that was known. I remember the Treasury and the Fed are, pushing on Lehman and stuff, and they didn't want to bail them out. They just bailed out Bear Stearns, and they didn't bail out Lehman. They were upset with the CEO. I think in hindsight, the $150 billion they would have cost to bail him out would have been a lot less than the $7 trillion we spent after that to try to bail out the whole country. The market dropped 32%. So that's a good example. Whereas, when it's a known thing, I can't remember a single instance where the market has dropped substantially about something that's known. And my analogy still stands where you're walking down a dark street, there's a big hedge, somebody jumps out from behind that hedge, you're going to respond negatively because you weren't expecting that. It's scary. If, on the other hand, somebody's behind the hedge and they might jump out, when they do, not nearly as nervous. And so those things tend to get kind of baked into the market. Again, I haven't seen anything happen. And it also has to have some economic impact. And you could make an argument that the election and who's in Congress and who's in president has an economic impact. And there is some issues there. But it's more of a longer term thing if there is something, and there's sometimes goods and bads.
If they're going to do any kind of economic, their executive orders or kind of bills, which don't happen instantly. They take time to be pushed through.
Yeah. Remember, it wasn't that long ago. We had massive protests over Black Lives Matter, over George Floyd, 26 million people involved. Market went up during that entire time frame. And then we had a January 6th, whatever you want to call that, invasion of the Capitol. Market went up on January 6th. Market went up on January 7th. And so it really has to have some impact on earnings, on company earnings. And neither one of those did in the end across the board. Certainly there's some things that happened. But so that's kind of something to think about just in terms, because I got asked that, all week this week in my different appointments. What do I think is going to happen with the election? So I'll just keep putting that out there. That's not my main concern. My main concern is really what the Federal Reserve is going to do, how earnings are going to play out, what's happening with this artificial intelligence picture, and mainly how inflation comes through. The economy's pretty hot. I know a lot of people don't think that, but it is. As a matter of fact, if you look at all the big domestic countries out there, we've had the highest gross domestic product growth of all of them by a long shot since the pandemic. So certainly on a relative basis, we are the envy of the world in that regards. And so, that means that people have money, earnings are growing faster than inflation's growing, the stock market's going bananas, housing prices are going up, household wealth has been growing at a very fast rate. I think the threat is inflation, and a resurgence of inflation. So I don't know that that's going to happen, but that would be the thing I'd be more concerned about than what happens with the presidential election, at least from the stock market standpoint. There's lots of other things to worry about from the elections, but I don't think the stock market is going to have a significant trouble with what happens. Could be wrong. And we don't react on predictions. I'm not going to make changes based on what I feel about the election. We're going to look at our universe of ETFs, and if very conservative things start to move up, then we will be moving into those. And our other things that we have moved down, then we'll move out of those. So, it's pretty self, predicting as far as that goes as to where we go. So anyway, I think this is a great time to be talking about the stock market. We spent a little bit more time on it today than normal, but I think it's worth understanding what's happening here and kind of embracing what's happening here, because this is where you can make money. And so anyway, look forward to being able to talk to you about this again in a couple weeks. I won't actually be able to do my summary next week. Again, I'll be out of town unexpectedly, but I will certainly do this again in 2 weeks.